Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again J. Michael Oliver. And he is, as I say, has been on this show several times in the past, not often enough, but he's with us again today, and I'm very grateful to have him. He's been with some major companies on Wall Street. He's on doing his own thing now, but he was with companies like, those of us old enough will remember E.F. Hutton, International Commodity Division. He's been involved in the gold market trading business for a long time, Commodity Division, and chairman. He studied with David Johnson, I should say, head of Hutton's Commodity Division and chairman of the COMEX. And so he has a very unique way of looking at the markets and has made some very great calls. He should mention also he had been, Wachovia Bank had been a client of his in recent years. But I always enjoy his missives and find them very, very interesting. And I suppose I should be spending more time and more attention to them because I'd probably make more money if I did. Welcome, Michael. It's really good to have you with me again.
Thanks for letting me be on the show, Jay. Appreciate it.
It's really good to have you with to have you with us again. You know, I heard a recent interview with Jeff Deist at the Mises Institute, Mises.org, and I would suggest to our listeners you might want to go there to listen to it. I thought it was excellent. It had less to do with the kind of things we want to talk about today and more to do with philosophical issues, economic issues. But I maybe should tell my listeners also The New Libertarianism, Anarcho-Capitalism is a book that Michael wrote that I think is really worth reading if you care anything about the issue of free market economics and the contrary, what we're seeing these days. So I would just put that out to my listeners as well. The New Libertarianism, Anarcho-Capitalism, and that's largely the topic that was discussed with my friend Jeff Deist at the Mises Institute. Well, Michael, you know, for the benefit of people who aren't really that familiar with your work, I'm sure there's some listeners that heard you before here today, but tell us a little bit about how you approach the markets. The way I look at it is my understanding of what you do. It's like you're more like an engineer that would look at a bridge and start to see some structural issues with the bridge, and that would be a warning sign that you better pay attention to what's going on here because the bridge could collapse. Am I in lay terms sort of saying what you do?
Basically what orthodox technicians seek to do when they look at price charts. Mm-hmm. They draw lines, support lines, resistance lines, trend lines, and so forth, and try to ascertain what the market's doing or is it breaking anything and so forth. I've long ago, 20-some-odd years ago, shifted away from price chart analysis as a primary, and I treat it as a secondary. Mm-hmm. And what I do is I detrend price against a mean. And we've all heard the phrase, and we all tend to believe it, I think, that markets tend to return to the mean. Uh-huh. Well, there's a lot of means out there. There's 10-day averages, and there's 100-day averages, and there's 3-year averages, and so forth. A lot of means around which markets in their price exploration process will, rise against or fall against or oscillate. I look at all various time scales of means in any given market so that I have a appreciation that, it might be in a near-term uptrend but a long-term downtrend, and I keep the two separated. I tend to focus more on the big stuff because that's where the big moves come from. And this past year has been quite clear in several major markets using the biggest oscillators I have, including annual momentum, which is generally if you measure something against, let's say, a 3-year average and you plot the price against it. I don't mean you overlay the moving average, but you literally plot an oscillator in which the price is plotted on the chart in relation to how much above or how much below that given average. And so you turn a price chart into an oscillator, and you get a totally different vista of the trend and the trend structure of the market by doing that. You can call it detrending it or oscillating it or whatever. I do it in bar chart format, just like a price bar chart. Mm-hmm. Quite often I'll focus on monthly bars, the big stuff, against long-term averages. And in so doing, you can usually early on identify the setup of a trend change. What generally happens at trend transitions, whether you're making a top or a bottom, is that the price action will continue to fool the trend followers, the majority who see new lows as, forever new lows, or new highs as forever new highs. Uh-huh. But we all know, academically, there has to be a new high that finally doesn't sustain and turns into a top.
Sure.
If you ask anybody, can it go on forever? Of course not. Then it's only an issue of when. Well, momentum will generally give you the signs of the when, non-confirmations, for example. But most importantly, it develops structures visible to the eye and to a straight edge that are not apparent on a price chart. Mm-hmm. And so consequently, for example, while a lot of people I can appreciate on a fundamental level who are very negative on the Chinese situation, Chinese stock market, based on alleged malinvestments and so forth, which no doubt have occurred over the years. The problem was the Chinese market had returned to the 2008 low. So to the extent that those malinvestments might be truisms, the price of the market itself was not pricing in malinvestments, it was pricing them out. So, effective is like the S&P back at, let's say, 700. So my momentum work said there was odds are on favorite that China would flip up at the same time the U.S. is having some problems. And it did. It went up about 40% since July when it broke out on annual momentum. Oil was another good example. It was lingering and languishing up there in the 80s to the hundreds, 110 and so forth for the last several years, just oscillating sideways, really, in a meandering pattern. And it was clear on annual momentum of oil, not on price, that when it dropped through $96 back in August, it had violated a massive 4-year floor. It was not apparent on a price chart. And you paid dues for that. You're still paying the dues. So I see price as a secondary. I use it to calculate momentum studies, and that's basically how I approach markets.
Well, it's worked very well. As I noticed, I took note of the Chinese call that you made. It was a really good one because I know at the time how negative I felt about China and how negative everybody else was talking about China. I said, "What's this guy talking about?" But sure enough, we just talked to Chen Lin from Beijing, a friend of mine, partner of mine actually, and he said, "Well, that's because the interest rates went down in China," or I think that's what he said. I don't know. But you're, as a technical analyst, not caring why so much as just what is really going on and detecting that momentum and the structure. And so let's look at some of the things that some of the calls you made looking back in 2014, category by asset category. We look at T-bonds first. How many people I've known, and myself included, who turned bearish on the U.S. Treasuries? It seems that they seem so ridiculously low. We don't have enough savings in the economy. We need to, all the excuses, all the ideas that people have why we should finally see a bear market after, 25 years of bull market in U.S. trade, whatever it is. More than that, I guess.
About that.
So what are you seeing in the Treasuries now, and what did you see in 2014? You called it right again. You were bullish on the T-bond.
Well, early in the year, in January, as the market came up off of a low, from the December-January low of late last year, early this year, came up to 132 on the futures. We're now in the 146s. It broke out over some very large long-term momentum structures that said, okay, the downtrend in price, uptrend in yield that had been underway since 2013 was over. We're going back up in price, lower in yield. Nothing since then has negated that. I do suspect in 2015 there will be a point where T-bonds top. But you've got to realize that they're the defended fortress, just like the German bond and to some extent the Japanese government bond. Right. They've got central banks defending them, therefore they'll be the last fortresses to fall. Right now we're seeing the less defended fortress of high yield come under attack, as it should. The central banks have created definitely a bubble. They've forced people into high yield by denying them conservative yields as a consequence, and they've created a bubble. That bubble is partly now being pricked by another commodity bubble with the oil market, which is like a torpedo, not headed to the S&P, but headed to the high-yield market, which in turn will be headed to the S&P. So it's an interesting situation that the central banks have set up. But, that said, I still think their instrument, the 30-year bond, for example, is safe because it will still be sought out as a flight-to-safety mechanism up to a point. And I suspect that turning point will occur sometime next year. My guess would be, I think the S&P is probably going to top here, is topping. Since October, I've declared it a topping process, not just a corrective process like the prior sell-offs. But if the S&P, in fact, is topping, I think it's going into the 1600s rather rapidly, probably within a quarter. That will be predetermined by where the market is in January. If it's below 2020 S&P, I think you're headed down. That point from a move from the 2000 area down into the 1600s S&P should probably cause the T-bonds to have their last flight to safety. And so at that point in time, if T-bonds in fact are pursued as an instrument of safety, if the S&P makes a low in the 1600s, which I think in the long run will be temporary, but could in the short run be enough, that could be a point where T-bonds peak. So that's what I'm watching for. But right now, T-bonds still are positive. Upside price, lower yield.
I see, but I mean, I'm wondering why, if T-bonds have worked so well so far, why they wouldn't continue to work, and I mean, as long as the policymakers can convince people that the dollar is better than gold or the dollar is better than any other currency, why not just go there even if the rates are negative?
Well, the dollar is long-term looks good, I think. I expected to move up to here. Right now, frankly, I look for dollar weakness over the near term, like the next month or so. Euro up. Yen might turn up pretty significantly here. I know we think that the central banks control their currencies and their bonds, and I think that is a mistaken notion. They've controlled them well up to this point, but I think even they are not gods, and they push a market into a situation where it's way beyond where it otherwise would be. There's a snapping point, regardless of their policies. And I think that the unwinding we're going to see in asset prices starting soon, if not already started, especially in high yield, is merely an expression of the unwinding of their controls over the process. In other words, they don't control it. They've priced things way beyond where they should have been, and now reality's coming back to bite them. But I do think the last fortress to fall will be the government bonds of Germany, U.S., and Japan is an iffy one that may come under assault sooner. But I do think our bonds and the German bonds are a safe place to be in the interim. But that could change.
Yeah. Well, it's interesting because I know, as one who looks at gold mining stocks a lot, that's basically what I do, gold mining companies, that we've had periods of time when deleveraging takes place, when the risk on and when the market sort of implodes as it did in 2008, 2009, as it did in the 1930s, when in fact the gold mining companies really do well because you have all the commodities, including, we're seeing it now in oil. I just mentioned in the monologue today that a year ago an ounce of gold would have purchased only 13 ounces of gold. Today it buys 22 ounces of gold, or did yesterday. And so the cost of mining comes down, and the gold in real terms tends to go up during these credit crises. That's what I've observed from a fundamental point of view. What are your thoughts on that?
I concur. I think gold has had likely seen its low. Bob, the last time you interviewed me was we were stuck in the probably mid-year, and the market was stuck in the 1200s to 1300 zone on gold.
Right.
And I had taken a stance early last year after the collapse. I was satisfied with the collapse. I thought that was enough possibly for a bottom. But I didn't see enough evidence of the bottom yet. It could go either way. It could take out the lows one more time, dual lows at 1180, or it could try to go up and break out. I had numbers above the market, which it never could achieve. So it was stuck in a range, a bottoming range. Well, I know there was a lot of fear over gold taking out those lows, the dual lows at 1180. But my assumption was, before it ever happened, and I put it in print, don't be afraid of that. The likely low is 1140, give or take. I had too many momentum factors saying there's support down at a given level on certain momentum charts that said if you'll just get to that level, you'll be okay. It should be support. Well, on a price chart, it was scary because it was a new low, below 1180 down. It scares people. But it was only, what's that, 2% drop further below those lows. I think it was a trap. I think it was a bear trap, and I think it quite probably was the bottom of the market. Right now, I'm about 60% convinced the gold has bottomed. We've rallied $108 off the low of October, as of the high of a week ago. Pulled back $30 since then. And my big numbers on gold that say that I'm up in the 90 to 100% conviction level at that point that the new bull is emerging, are starting at 1290 to 1300 range, especially in the first quarter of next year. If we can post a monthly close up in that or slightly above that zone, I think at that point it's a table pounder. I think it's over. Gold's in a bull trend again. And I'm also reading that evidence in the spread relationship between gold and the S&P, which I sent you a report
Yeah, you did. Thank you for that. I'm looking at it dated December 16th, I believe.
Right,
and talk about that a little bit, if you would.
Well, what I do is I simply measure the price of gold in relation to the S&P. I divide gold into the S&P, express the result as a percent, and you plot the chart. That's a spread chart. It rises and falls. Gold obviously has fallen in spread relationship, in performance, since its 2011 peak. But my work suggests that spread is bottoming, and that it is only about 3 percentage points away from a major upside breakout in momentum of the spread. Specifically, right now, if you divide spot gold into the S&P, cash price of the S&P, you end up with an of a percent of 60%. Gold, 60% of the price of the S&P.
S&P, yeah.
If that rises to about 63 to 64% over the next few months, and it changes each month, I specify in the report. In my opinion, at that point, gold has turned the corner. It will now, henceforth, for the foreseeable future, outperform the S&P. Now, quite often, spreads will turn coincident with net changes in price as well. So if, in fact, gold is bottoming, as I suspect, then I would expect the spread to be giving off the evidence that it is, and it is. And so I have two things to look at there as regards gold. And if I get both of them, I get gold up through 1290, 1300, and that's not that far away because we were 1239 a week ago.
Sure.
And I get this spread to break out, then it's major bullish for gold on a net basis, major bullish for gold on a relative performance basis to the equity asset class. I also happen to believe, for various reasons, and I could use some more evidence, but I tend this way, gold miners should beat gold going forward.
Gold miners should outperform gold.
They should outperform gold going forward. So rather than buying gold, I would suggest you find your favorite gold mines or ETF gold miners and proceed that way.
Yeah, certainly there's some good ones out there. I know one that I just recently ran into is a Sprott gold mine ETF that I think is very good, but there is others out there as well. So this is looking really good. I notice on that chart that you're talking about, the gold S&P spread, you're using a 10-month moving average. How do you determine what moving averages to use? There's no one that's a wholly average. That's a long-term average. That roughly at 10 months is roughly 200 trading days. So it's roughly the same as using a 200-day average against which to oscillate the spread readings. I also commonly use a three-quarter moving average, which is 9 months. That's similar to a 10 months. So those are about equal duration. I call those long-term yardsticks by which to measure price, oscillate price around. I go out even further. I can go to 3-year averages and so forth, but that's long-term enough for me to be convinced that if it turns up on that scale of momentum, if the spread turns positive, and momentum will turn first, by the way, before it becomes obvious on the spread. Sure.
But I'm convinced. I'm convinced enough. It's a big enough time scale. You don't want to be looking at some short-term thing, a 10-day average or 3-week average or something like that. You want something of long-term duration. So when you get a signal, you have
it's real.
Long-term, yeah.
Yeah. Well, then, looking at this chart, if we see this, if we see this momentum spread rising above that 10-month average, that would be a good sign. That would be a bullish sign. That
would be a bullish sign. It would say from now on it's time to divest oneself of S&P equivalent assets and buy gold equivalent assets.
Yeah, I mean, I'm looking at it when it went below that moving average. We're going back into 2012. That's when you said you turned bearish on gold. So you would have done very, very well if you sold your gold stocks and sold your gold and went into treasuries or something else at that time.
Or went into the S&P, God forbid, but it S&P. But things change, and that's the nature of technicals. The fundamentals can always be true. The question is always, though, when does it become actionable and true? And that's a technical issue. And
well, you certainly. What are your thoughts on oil? How much further do we have to go in oil, crude, before we?
When it broke 96, I expected a major decline into the 70s. I even postulated it could see 65. My main focus wasn't on where is it going to bottom.
Yeah.
It would have nuclear effects in other markets. And I thought that the reason oil did not implode when gold did 2 years ago, or when grains did, and held itself back, was that it wanted to be roughly coincident with the top in the S&P. And I think that may be happening. I suspect there's a lot of talk right now about buying energy stocks. And I can't argue with that, except I don't have a technical reason to do that. Yes, they've been beat up. Yes, oil's been beat up, and they're not going to zero. But I suspect the time to be looking to buy oil and oil stocks is going to be late first quarter, early second quarter next year at levels lower than this. But around the time the S&P, if it breaks down, which I suspect, gets into the mid-1600s, at that point I think it's time to then look at oil and look at oil-related stocks as possible buys. Not that the S&P will be, but on a relative basis they will be. But I think they will go with the broad market. And I don't think they're going to turn up if the S&P is about to turn down, which I think it is. So I think it's premature to be an energy-related buyer.
Right. How is the same hold true for nat gas?
No, nat gas is a different world. I think nat gas is a slovenly, slow bull market. It has its big pullbacks, and I suspect somewhere down in here in the mid to low threes, it's a buy again. Most energy markets, if you plot them going back 10, 20 years, even nuclear or anything else you want to look at that produces energy, has had the kind of collapse oil is just now having. So it's not their turn to suffer. They've already suffered. I mean, nat gas was under $2 back 2 years ago. So, I mean, what do you want? They're not going to zero. And, you can look at supply and demand and all these things, but, ultimately price is either underpriced to a mean or overpriced to it, and I still see natural gas as an already bottom bear market, a fairly early bull market with another leg or two left in it. And so I would be looking positively at natural gas, certainly from, let's say, 360 down to 310 or something, though there's more specific timing that could be done. But I wouldn't connect it at all with oil. I don't think the connection is justified.
Yeah, two different worlds, as you say.
I think so.
I would just, I see my engineer's telling me we only have a couple of minutes left. So this is sort of maybe a philosophical question or a question for a technician from a fundamental analyst. David Jensen is an engineer who is on this show often, and he talks about how he believes and I do too, I share his belief that there's some hanky-panky by some of the big, let's say, oligopolistic players in the paper gold markets. And David believes that you can't make much sense from a technical perspective on the COMEX market or some of these paper markets. He says the Shanghai market is a pure physical market, and that's gold. He says you may as well be calling it widgets or or anything else because it's really mostly a paper market, and very, very small amounts of it gets settled out in real bullion. What would be your response to a fundamental guy like David, an engineer, who doesn't think there's much value in looking at technical analysis from the paper markets?
With respect to him and you, I disagree. I think the market, the gold futures market, has always been somewhat paper in that sense that it's not often delivered against or accepted delivery of. That's a small minority at the other end. And I think the technical behavior of gold is optimally visible. It is not mysterious. I've not had any problems with it for several years, and I'm sure there's others who haven't. The explosion in 2009 to 11 was readily apparent. The top in 2011-12 was readily apparent with momentum. And I think what now is a bottom is pretty clear. And its behavior is, as far as I'm concerned, no different than any other market on a technical basis in terms of especially at transitions where a market gives you deceitful readings, like a new low in gold, for example, or the S&P last month, a new high in the S&P. You have to expect that deceit. I don't think it's manipulation. I think it's just over-enthusiastic trend followers the other way, in this case gold, the bears.
All right, well, good enough.
They were going to party, and they didn't party,
Yeah, well, that's fair enough. I mean, as another technical analyst said on this market, on this show, he says, Jay, I don't know of any market that hasn't been manipulated from time to time. So that's just, human nature, but whatever. We are out of time. Michael, I want to thank you very much for being with me again. Always a pleasure, and I look forward to doing it again sometime in the near future.
And thank you, Jay.